Hello friends, you are a company to whom IFRS is applicable and now you are planning to set up a factory worth 100 crores. Suppose you have say 100 employees and you use them full time to construct this factory and the time period for constructing the factory comes to around 10 to 12 months. And suppose that the salary of paid them for this period, for this 10 to 12 months comes to 1 crore rupees. That is, this is including the basic salary, the post-employment benefits like gratuity, PF, etc. The whole thing put together comes to 1 crore. So this 1 crore, should this be capitalized or should this be expensed to the profit and loss account? Let's discuss in today's video. Hi, my name is Pratheej and welcome to Deep Dive into IFRS. So before getting into this example, let's understand how the property, plant and equipment should be measured, the initial recognition, the initial measurement and the components of cost of a property, plant and equipment as per IAS 16. So the initial recognition, that is when a property, plant and equipment is bought, it should always be recognized at its cost. The cost can be equated to the sacrifice you make to acquire that PPE. That is, suppose you're buying a machine. For that machine, you must have paid some cash equivalents, and apart from that, suppose you're giving up an old machine that you have with you to acquire this. So the value of this cash and cash equivalents and the fair value of the machine that you give up, these put together form your sacrifice, and that should be recognized as cost in your books of accounts. But there is one small exception to this. Suppose instead of the old machine that you're giving up, you're giving some shares of your company. In this case, the fair value of share should not be included. In that case, only the cost of the property, plant and equipment that you acquire, that you buy, that should be considered as cost of the property, plant and equipment. Only if this is not available can you go to the fair value of the shares that you give up. The reason is because as these shares belong to you, there is a chance that the fair value can be manipulated and the inflated figures could be brought into the books of accounts. That is a specific reason why this comes under the ambit of IFRS 2 share-based payments. Now let's look at the components of cost as per IAS 16. There are three main components. Number 1, purchase cost. Number 2, directly attributable cost. Number 3, decommissioning costs or dismantling and restoration costs. Now, purchase price includes the actual purchase price that you have paid for acquiring the asset, including non-refundable taxes, import duties, etc., reduced by trade discounts and rebates. When it comes to the directly attributable costs, the standard itself lists down 5 components that can be shown under directly attributable costs. Number 1, delivery and handling cost. Number 2, site preparation costs. Number 3, installation and assembly costs. Number 4, test costs. Number 5, professional fees that you pay to engineers, legal people, architects, etc. Now, when you're doing a test run, that is what test costs mean. When you're doing a test run, generally you produce some samples, and upon sale of these samples, if you receive some consideration, that amount should be reduced from the test cost and the net figure only should be shown. Now, finally, decommissioning costs. Suppose upon acquiring a PPE, as per the contract or as per law of the land, after the useful life of this property, plant and equipment, you are supposed to dismantle it, clean up the site, do the restoration required, and then give the land or property back to the government or the owner. That is called the decommissioning costs or dismantling or restoration costs. In a subsequent video, I will give an explanation to this and tell you how this should be accounted for as per IFRS. Now on to an example of whether to capitalize the full-time salary of the employees who are engaged in the construction activities or not. The employment benefits of these employees, that is salary, including the post-employment benefits like PF, gratuity, etc., can be capitalized and added as part of the cost of the property, plant and equipment, provided these are directly attributable costs for making the factory ready for its intended use. That is, these employees should be working full time for some construction or installation related activities with respect to the factory. If suppose they are not working full time, suppose they are into some other manufacturing activities, the normal routine operations of the enterprise for say 40% of the time, and balance 60% of the time they are engaged in the installation and construction of machineries and the factory setup. So in this case, only 60% of the salary and the post-employment benefit should be capitalized as part of the property, plant and equipment cost. And once this factory setup is done, then from the next month itself, from the next day itself, whatever salary and post-employment benefits are paid to these employees, those should be expensed to the profit and loss account. So I hope this example was able to shed some light on how to account for the property, plant and equipment at its cost. Till I see you in my next episode. Thank you for your valuable time.